First, the bad thing, or rather the not so good thing, which is essentially there is a high correlation between steel prices and iron ore prices.
Yes.
So that may have its own implications.
So that means steel prices would also have to go down because iron ore prices
It's
have
not a
stopped.
question of going down. It actually plays like that. If these closures happen, if the new net additions go down, and if the need for higher quality of raw materials increase the cost base of Chinese industry, then there is a potential that they may vacate some of the export markets. And if that happens, then you would have a lot more rebalancing of regional supply and demand. And if that happens, then you would certainly have a better price scenario going forward. The structural margins which actually moved out of the Western steel world may come back partially or wholly if this pans out to be something which sustains for some time.
Are you seeing a further downside in the iron ore prices from the levels that it has reached right now?
It's a interplay between many of these factors. This is not single factor, but our sense is that the prices will be range bound perhaps. You must know that the impact on HRC, which we talked about, there is a high correlation, is also when there is a lot of capacity available. If you have lesser amount of capacity available, then it will have a different implication.
Talking only about domestic market, that could be a little negative in some sense, because you have a competitive edge because you have your own iron ore with you. But then if the prices go down, then that competitive edge could be lost to some extent.
The internal performance measures on both on our productivity, volume increases and cost, and the product mix of wanting to produce higher grade of products for more sophisticated consumers have actually taken us to a level where the amplitude of the volatility of prices and margins have really shrunk much more significantly.
How much of a dip could we see really in steel prices? And I wanted to also bring about the factor that rupee is playing, because now it's strengthening because of better macroeconomic data.
Rupee plays a part against imports, where we have competition, especially in the automotive grade, where we have taken market share or sustained our market share. We will have more volumes coming in. We will have new products being developed. We will have certain cost related benefits like coal, which we import from Australia. So net on net, we should expand.
What is the outlook on steel prices going forward for the domestic market, because your more lucrative part of the business lies here?
So I think iron ore prices reduction will reduce potentially the base of the overall steel prices globally. As far as our prices are concerned, and I think we can keep laboring that point, but our view is that at this point of time we are looking at price increases in our OEM segment. If the trend for the iron ore prices continue, if the raw material prices globally soften, there will be softening kind of trend towards, say for example, HRC prices, which are very directly correlated. But then our challenge will be to keep on producing more value added products and supply it to the customers.
But HRC being the yardstick, it will in return have some impact on the marginal increment that you do on every product as well.
The prices would be largely stable. That's how we should look at it, because the supply demand balance of those products which we sell are not readily available, especially in the automotive sector. So we have a space which we will expand, and with more volumes coming in next year, that should be a good trigger for volume based increase in profitability also.
So that was India, but you did talk about the volume push, and that is something that is playing out pretty well in the European markets. Your operations in Europe has substantially improved. If China's story plays out the way you are expecting it to be, then you will get a lot of headroom for pushing more volumes. But if it doesn't, what would be the key drivers for a sustainable growth when it comes to the volume push?
Well, I think that compared to last year, we will be selling more this year. Last year is in 12-13. Compared to that, we will be certainly be almost about, I think, 1 million tons.
What kind of EBITDA per ton we could be aiming at in the quarters to come?
Where we are, we will certainly continue to target expansion of the margin, but I wouldn't put a number to it because that's not fair for anybody.
70,000 crore rupees is the kind of debt levels that you closed the last quarter on. What is the kind of step or the planning when it comes to reducing the debt levels?
I think it is prudent to say that at this point of time, we have spent about 12,000 crores in Odisha, largely out of internal generation. We would start drawing up for the balance. So if you look at the Odisha level, we will look at now drawing up some part of the project debt. But we always use it as a filler beyond our internal generation. So if we can fill it up with internal generation, we will certainly execute this project with more and more of internal generation. This whole process will first get completed when the Odisha project gets completed. That's where we are looking forward, because that's an important milestone. And then we will work on deleveraging further.